the leading leg of the chain there. That's pretty much where a lot of you come and where a lot of you, quite frankly, end. You want to generate income for your clients. You want to improve your returns. You want to chalk up those basis points a little bit, and income is the way to do that. And one of the leading, if not the leading income trades is, of course, our old friend, the covered call. It's pretty basic. It's straightforward. Your clients, even you as the advisor, you all understand a long equity position, and you all understand how to work a limit order to get out of that position. And so the notion of getting paid for that, it makes a lot of sense. It rings true to a lot of the audience. But that invariably leads to the next question that we receive quite a bit. And it's an interesting one. It's a contentious one. It's a somewhat subjective one because the answer is going to vary depending on who you ask. I could pull aside 10 different people from the option space and ask them this very question, and I'd probably get 10 different answers as to when they like to do it, which makes it worthy, I think, of discussion on the show. That question, of course, is what do you do when things go your way? So you buy, let's say, XYZ stock is trading at 100. You sell the 110 call for $1. And so now you have that nice covered call position on, and then the stock immediately rallies to 110. What do you do in that scenario? There's a lot of things to unpack there, of course. There's a lot of things that could potentially dictate what you do there. Maybe your client has some tax situations where he cannot sell the underlying, in which case, guess what? You're rolling or you're closing. Or do you let the position just go the way it is, kind of the old Ronco style, set it and forget it type trade? Where you put it on, you sell the covered call for, let's say, a monthly covered call for $1. If the stock gets called away, you rinse and repeat and do it again the following month, and you keep doing it over and over again. Obviously, there's tax considerations there. There's some effort and time considerations there as well, but that could also be another way to go. So there's a lot of different ways to approach this. Maybe we'll start off, Chris, I know this is kind of what you deal with day in, day out over there. Obviously, there's that income component to the DRS that you're managing on a daily basis, and this is an interesting question. I think it's an interesting subjective one. That's why I kind of wanted to get everyone's different thoughts on this. But you're out there effectively managing that short component, that short strangle component of the DRS on a daily basis. What are some of your use cases, maybe some of your best practices, maybe some of the rules you guys implement when you're deciding whether to roll, whether to adjust? How do you guys work all that out there?
Well, anything in trading falls down or falls back to, trying to maximize your expected value equation, right? So what's your probability of win? What's your probability of loss? What's your average win and then your average loss? So one of the things that we look at is where can we maximize that formula? So, and it comes down also to, well, what kind of capture rate are you getting? And I know we're just talking about the call side right now. So, there are points in time where you're just not collecting enough theta to sit on the trade anymore. Maybe the volatility has collapsed and it's not a good risk reward proposition to hold on to that short call anymore. So again, it falls back to maximizing that expected value. That would be when we would just go in and close the trade out. But then there could be other times where the term structure, right, is more favorable to where you close that out and you open up immediately on another call because the volatility is higher in the back months, et cetera. So it's really a combination of those two things that, we don't always roll. We don't always just close. So it's really about what kind of market environment are we getting with respect to, and where are you with the time spectrum, right? So how much theta is left? What kind of volatility environment are you looking at? And what kind of term structure you're looking at?
Yeah, those are all many components that you need to consider out there. And again, if you're intimidated by those terms or not sure about all of them, of course, check out some of the early episodes of this program where we explain things like the Greeks so you can understand things like theta and vega and gamma and all of that good stuff out there. Matt, one of the reasons we like having you on the show, in addition to your scintillating personality and your deep and long-held analysis of theme park wait times, is that you come armed with some data, and you usually have something in your back pocket for these different scenarios. And I'm sure, I'm going to go out on a limb and say I'm not the first person, Matt, to ask you about some rule sets for when to roll, when to adjust. I'm sure people have come to ORATs with this question in the past. So when they have, what are some of the things you guys have uncovered over there?
I feel like you're using me, Mark. You only want me for my data.
Yeah, but it is such good data. Can you really blame me?
So, of course, I went out and ran a bunch of tests. We have a new optimizer feature in our back tester where we can put in 15 days to expiration, 30 days to expiration, 45 days, 90 days, deltas, 10, 20, 30, 40, 50, exiting at a profit and loss, losing 75%, losing 50%, making 75%, or do nothing. And then you combine all those and you get thousands of tests, and You shake them all together, it comes out in a table. And when you sort them, I have the winner here, Mark. Do you want to guess it between 15 and 90 days?
So which end of the spectrum works the best?
Came out best. And of course, this is for SPY. So obviously, from 2007, we've had a rally. So, well, I'll tell you what. I'll let you off the hook.
I'll venture a guess. So it's somewhere between 15 and 90 days is your data. Normally you would say 15, right? Because that's where you're harvesting the most. You're getting the most bang for your buck. You get to repeat that over and over again and roll. But the fact that we have been in a little bit of rally ho mode, I might go a little bit farther. I'm going to say 30 days.
Yeah. So, and then the delta, I'll tell you this: the worst delta is the 50 delta. So, because in this rally mode, you're just, you're getting called away. It's rallying, getting called away. So the winner is the most conservative, actually 1.37% a year. Not too bad for the. Let's see here. The 1.37% a year. For the 15 delta, the 10 delta 15 days. So that's pretty far out of the money and still collecting some though, 1%.
That's kind of where I would usually lean, because that you can repeat that over and over again many times, obviously, in that 90-day period. So that's good to hear that one still is holding up even in this this crazy scenario we find ourselves in these days.
Yeah, I mean, nowadays you're getting 30 cents, for those out of the money 15-day 10 delta calls, something like that. So you're just kind of rinsing and repeating. And then, interesting though, there is an exit on that, because a lot of times the exits won't be used because you're costing yourself. We have a commission and slippage assumptions in our back test, so halfway from the midpoint to the offer or bid to get out. But in this case, if it goes in your face too much, it wasn't an exit on profit and loss that we tested. So that's don't exit on that. This is saying, but exit if it goes against you. So if it goes all up to a 75 delta, so we measured 95 delta and 75 delta and nothing. So of those three, it's saying, when you have a 15 delta, when you have a 10 delta, that you open and it goes to a 75 delta, so way in the money, that was the best time in this particular strategy to roll. That maximizes Sharp and Sortino as well. So again, the worst ones are over hedging. I mean, getting into perhaps a 45-day 50 delta, and then getting out if you make 75% of your money, or if the stock goes against you, was the worst one. So I could go on, but those are the tops and the bottoms of this of all those scenarios that we ran, Mark.
I like it. So listeners, if you want to learn more or get more insight into that information, hit up Matt over there. Give him a follow on Twitter at OptionRats. He tweets out a lot of that data as well. Head on over to orats.com, ORATS, or hit him up maybe at Matt at orats.com, and he'll provide you with some more information on that, because this is a contentious subject. You probably could fill many hours with this, Mr. Matt. But thank you for sharing your data on this. Now I also would like your spreadsheet on the ride wait times, please, because that will be very useful for me in the coming week. Mr. Eric, you're out there kind of picking the brains of the advisors hither and yon. You're at pretty much every advisor-oriented conference I could think of. I'm glad you're out there doing it, because I certainly would not be able to travel to all those different events. So you got your fingers on the pulse of the options-oriented advisor community. When you're talking to them, Eric, obviously covered calls are a big issue with them, a big top-of-mind thing for them. What are you hearing from them? What do they like? Do they like to roll? Do they not? Do you have any nuggets you've heard that are interesting you'd like to share with our audience on this subject, sir?
Well, it's interesting. Matt is the data dynamo, but I was hoping that he was going to sing a little bit and sort of say, a little Kenny Rogers there, knowing when to roll them or knowing when to hold them. I mean, I was going to hope that I was going to get a little bit from Matt on that.
That's why we have you on the show, for your fantastic pipes.
You heard me singing at OIC. I think that's why.
Exactly. But I mean, look, Chris and Matt bring up some great points, and I'll elaborate a little bit on it because I'm fortunate enough to be with the three of you, my colleagues and good friends of the OIC. But, listen, advisors tend to think about the concern, Mark, is, the assignment risk. And, when you're looking at tax issues, is it a non-qual account? Are there transaction fees? But that doesn't really play in as much, relative to advisors. But it's like, do you unwind? I mean, are you going to roll up? You're going to roll out? But one of the things I was going to share, which one of our colleagues that all four of us are familiar with, the infamous Jim Bittman from the SIBO, has, at one point, I remember him telling me, and this might be an interesting analogy, Mark, for you being down around the Disney area. Jimmy once said there was he used this analogy, like you started out, for the grocery store and ended up going to a movie theater instead. So I guess I'll use the analogy, Mark, that you ended up wanting to go to Space Mountain, but you ended up going, over to the new Harry Potter and got stuck in a line. And it's kind of like, this happens like with covered calls. You talked about it, Mark. You buy something, an XYZ, and you're confident it's going to sort of moderately stay in this area. You're looking at you're hoping for a nice return, the income word you said, with this nice sort of static return, and possibly even better, you're getting this, if called rate of return. And then all of a sudden, some better news comes out, and, this thing starts to go parabolically high. You got long-term growth, really. So, in that respect, Mark, I would tell you that covered calls definitely are very popular. But what I would let you, kind of your listeners is that advisors need some of the guidance. I think that's where Chris's group is real good, Matt as well, and others. It is subjective, Mark. I think you really hit the nail on the head. I mean, advisors really look at this from the standpoint, are we systematically adding a strategy? And I hear really in the field, Mark, a lot, and you've come across it. Advisors sort of systematically set up a roll strategy. If they get close to that strike, they're going to roll it up and out.
It is interesting. I like that analogy of Harry Potter versus the grocery store versus the movie theater. We'll mix all the analogies together. But and I like that data there as well, Matt, because that kind of reinforces what I've said on this network many times, and what a lot of people like to use. And I think it answers the question you bring up there as well, Eric. I like leaning towards the shorter end of the spectrum in the weeklies. A couple of weeks, 15 days was the shortest you measured there, Matt, for a couple of reasons. A, it obviously maximizes the theta, but also B, it gives you that opportunity to roll and adjust on a more frequent basis. So if something does happen, if the underlying does, you think you go into the movie theater, you end up going to the grocery store along those lines, you're spending more, your stock's changing its fundamentals, it's moving a lot more. In a shorter time frame like that, you get more opportunities to adjust, rather than if you just write a call once a quarter or once every 6 months or, God forbid, once a year. You don't really have those opportunities to adjust and change your outlook. So I like the shorter things for that reason, in addition to the fact that obviously it's going to maximize your exposure to the Greeks, which we like. Let's go back around the horn really quickly here, get all of our closing thoughts here on this. We could do many episodes on this. I kind of want to touch on it now. I got a feeling we're going to hear from a lot of you on this, and we'll probably come back to it again. But in general, Chris, we'll start with you. Some closing thoughts on, in general, when should you roll your calls? Should you close them out? And just some general rules of thumb you like to live by in this scenario, sir.
Well, I think it starts out with defining, what is the overall objective here with your risk and reward. And so I know we're talking about shorter term calls, but I also know people that manage underlyings and they do 1 year covered calls. And basically they are satisfied with that return that they could get over a 1 year period. So, covered calls are probably the first option strategy that anybody learns when they start dabbling with options. And don't forget about the long-term space if you're trying to lock in some type of return. And that's what fits your risk reward profile. There's nothing wrong with that.
Chris says you can write long-term calls. I say nay and I shake my finger, but I'm just kidding. Whatever your use case is, but we like to lean short here. That's just the way it goes. And Matt's data backs us up, right, Matt? You're the reason I say these things. I blame you.
Yeah, I'd like to echo what Eric and Chris have said, though. It depends on your investment objectives and what you're trying to get out of the options, right? So if you're using what we're talking about, Mark, our favorite little ones, selling the little calls way out there, that's not going to give you much protection. So one of the things selling a juicy 1 year call could do is if the stock goes down, you still get quite a bit of premium. Whereas you're not going to have much protection. So it depends on your investment objectives, like Eric and Chris are talking about. If you're going for pure returns, maybe those shorter term ones. We represent some pension funds that have PMs that don't want to get called away very much. So we look at the call away percentage. So there's a lot of different objectives that you're going to want to be maximizing. Win rates are important some places. Some places may not have the underlying, so they have to manage just the amount coming and going. So they'll have to roll, as Eric says, roll out. There are other considerations, but and I should also say that different stocks have different personalities, and we used to back test tick data on how to hedge our gamma when we were market makers, and we definitely found certain trends in certain stocks. IBM was a one-way mover. Nextel was you'd want to scalp that a lot more. Well, I think it's the same thing with make sure you know your stock and know your test similar stocks before you get your strategy all together, Mark.
Yes, obviously, you're doing the little bite-sized ones. They add up to more usually over time, but they don't give you that meaty pull off the bone that you get with some of those longer term ones. And also, I know I hear from a lot of this audience that you're busy, and I get that. You're managing clients, you're trying to grow your AUM and everything else. You don't have time to maybe write things in the weeklies or even the monthlies sometimes. I understand your other reasons why you'd like to go a little bit longer out. I understand that. Just if you want the pure optimal approach, that usually tends to be the way to roll. But again, to each their own. Their mileage may vary. Mr. Kopp, bring it home for us, sir. Any final thoughts here on this heated, contentious topic of covered calls and when to hold them and when to roll them, sir?
I think it warrants another recording, Mark, because you're right. There is so much more to talk about it. Echoing Matt and Chris again, I mean, there's a lot of flexibility, and I think it really comes down to what your investment objectives are and, where an advisor and their client are sitting on the same side of the table and, how they want to define, that sort of alpha income generation. And, look, we all know, all four of us talk about this all the time. It requires a little more effort, a little more time, rather than just putting on the contract and forgetting about it. You have to do a little bit more work if you're going to end up closing something out and rolling and doing other things. But that's the beauty, Mark. You say it all the time. That's the beauty of options.
That is the beauty of options. Let's see if there's more beautiful things in store for us as we keep on rolling, pun intended, right on into the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everybody, welcome to The Buzz. This is the segment of the show where we break down the things that are going on in the world of options. Maybe they slipped onto your radar. I get it. You're busy. You're out there managing your clients' portfolios. You don't have time to stay tuned to the latest news on, let's say, for example, theoptionsinsider.com. So we do it for you. And let's kick things off. Before we even get into all of that, really quickly, Eric, everyone else has had a chance since OIC to kind of come on here. I think we all attended. Eric, Chris attended, Matt attended. I was obviously there. I know you were there. So everyone has had a chance to kind of weigh in on their thoughts from this year's big OIC conference. This is the first time you've been able to join us since then. So let's start there. Give us your thoughts on this year's event from Miami and what really resonated for you, as well as, of course, you ran a panel on there, which I believe Mr. Oratz may or may not have been a part of. What resonated for you from that as well, sir?
Well, I first want to thank Matt for being on the panel last month, and also Chris for making his appearance at the OIC conference in Miami. Mark, you there with Gene. I mean, we're always so appreciative of all your support. We really are. And, one of the things I would mention to everybody and your listeners, which people who are keeping score, OCC had some record volume, Mark, in May. May volume was up 13.1%. And, clearly with a lot of volatility, a lot of news going on with tariffs and what's going on in Middle East and other things all over the world, certainly not only retail and institutional investors, but advisors are paying a lot of attention to what's going on and seeking out sort of option strategies to really kind of help themselves.
But I did hear, and this is just me and you talking. There's no one else here, Eric. So just the two of us. But I did hear that Matt guy was a real drag on the panels. Is that correct?
Well, I have to say that there was a small delta that he would be rolling in from the South Beach. Supposedly he was there with A-Rod and J-Lo, and they were on a yacht, and I won't get into the whole thing because I think A-Rod follows the data that ORATS provides. I have heard that rumor. I'm not really sure of that. And Chris, I know, was probably also down and enjoying, some of the social atmosphere of Miami. But overall, everything was really well attended, and it was really an exciting panel. And Mark, you did a super job, that participation you had on the agenda.
Well, I appreciate that. Thank you very much. And I did hear from many non-biased sources, including ones that don't work for me, that the Hall of Fame was the highlight of the thing. So we'll just leave it there as it will. But you mentioned the record month of May. Let me hit on some numbers there. You touched on a few. Obviously, May. It's been a strong month. The year still down from last year, but last year, of course, was a crazy outlier a year. ADV volume right now for the OCC is about 19.6 million. That's down 8%, but that's compared to a record-breaking 2018. Overall volume in May, 465 million contracts roughly. That's a 13.1% increase compared to last year. Overall options volume, remember, they clear other stuff at OCC, not just options, but mostly options.
Correct.
Overall exchange-listed options volume, about 456 million contracts. That's up about almost 13%, 12.9%. Equity options, drilling down a little bit farther, about 406 million contracts. That's nearly an 11% increase from May of last year. ETF options, that's been kind of a bit of an interesting sore spot of late. This last month, not so much, up about 16.5% or 175 million contracts compared to May of last year. And index options, that has been another sore spot of late, up 33.2%, over 50 million contracts in May alone. And then futures, another area that's kind of been light ever since VIX-ocalypse of last year wiped out, took a lot of VIX futures off the board through the death of XIV and a bunch of other products. This May, lighten it up about 20% with over 9 million contracts in May. So pretty much wherever you looked, equities, indices, futures, what have you, it was a strong month for options, which is good for all of us here on the show. And of course, for you guys out there talking with your clients, it's a good little nugget to have in your back pocket as well. Since we're talking equity options earlier, Matt, you are indeed the keeper, not just of wait time data, but also of the earnings data. And we're kind of seeing the season kind of wind down. We like to get our kind of monthly check-in from you guys on maybe some highlights, lowlights, things that really resonated to you. I know last time we talked, you were saying that the dark side was leading the charge this cycle so far. Is that still the case? And as we're winding down the season here, any other last takeaways for you, sir, before we start the whole thing again in a couple of months?
Yeah, we're getting ready to get the Q2s coming through, but there's just been a few. I guess Adobe's coming out, but there's just been a few to add on to that. But it's not going to change what was probably the biggest dark side victory that I've seen since we started compiling this, Mark, since you pushed us to compile this those few years back. But 70% winners for, if you would have sold the straddle versus buying the straddle, it's usually 60-40. And back in October, it was 45-55 was the score. So very skewed this year, or this quarter, I should say. And I think what happens is the market kind of leans one way, leans the other, overcompensates one way, overcompensates the other. So I don't know that it's going to be that predictive for the next quarter, but it's going to be a fun July coming up, Mark.
Yeah, that always seems to be the case, doesn't it? These names tend to underperform, which is the case if the premium sellers are winning. So guess what? They tighten things up next cycle, and then we blow the doors off it, right? 2x, 3x, 4x, and all of a sudden premium buyers are winning the day. And thus the endless cycle that is earnings trading, sir, which is why we typically counsel people to stay away from it. But, sometimes you got to go in there, Matt. Sometimes you got to go do it. And if that's the case, you should at least arm yourself with the right data. So again, you can check all those earnings move results reports up there on the old website, theoptionsinsider.com, or check out ORATS. The blog has them up there as well. And maybe you want to upgrade to the pro version. Well, you can do that over there at ORATS as well. Let's keep on rolling with the buzz here. One of the hot things, Eric, I keep hearing about, people keep whispering in my ear about this new certificate program. and there's some guy running around out there just going crazy with certificates and talking the gospel of options and certificates. And rumor has it that might be you, sir. So what is going on with this new certificate program? Catch our listeners up. What are you doing over there with IWI? What kind of courses do they offer, and what can they do? And it looks like a lot of people have already signed up. What are they signing up for?
Well, I appreciate it, Mark. Actually, this was something that I was really passionate about almost a decade ago, was to get something out there that advisors could utilize and show that to their clients that they actually went through an extensive course, learned just not the basics, but was able to delve into volatility, obviously learn, different strategies and such. And so what we did was we collaborated with the former IMCA, Mark, which is now the Investment Wealth Institute, the IWI, and we launched at the beginning of this year Option Strategies for Advisors, which is 6 modules. It's on demand for those that already have some accreditation, advisors that have the CIMA, the CFP, or the CPWA. They get 8 C credits for this. But, the topics, as I said, they range from sort of an intro to markets. We do get into really, portfolio management. So let's just say right lane to sort of middle level. And it gives advisors, but also, Mark, I would say that external wholesalers, hint, hint, this goes out to Mr. Hausman and his firm, but that there are overlay managers there that have external wholesalers, their sales force that's out in the field talking to advisors about using overlay funds and hiring a manager. And so this course is also a really valuable tool for those members of these investment management firms that are out there talking options to get their staff to go through it. So we're really excited. Yes, we do have a fair amount of firms that have signed on. We have a few of the exchanges that have even looked at it. And so the long and short, no pun intended, Mark, is that we created the content. It's my voice. If you get tired of my voice from the infamous Coffee with Cot that's on the Options Insider Network, you just got to be prepared for my voice. But it is IWI that actually controls and is offering the course through their website.
So just to recap, then it's 6 modules. They pretty much run the gamut, would you say, of basic options education, or is there some tax stuff in there as well? Is there some regulatory stuff? What kind of topics can we expect?
Well, I won't want to say we really delve into synthetics, but we do get a little bit into the vernacular of the Greeks. And so, yes, absolutely. We kind of take an approach that some folks still want to get some of the basic knowledge, and we don't go too esoteric, but, we delve into, I would say, some mid-level. And so by accomplishing the course at your own pace, which is wonderful. Mark, you talked a lot about, how all the digital assets that are out there right now, people want to do things, in a virtual environment on their own time. This is a great way to do it. And so
let's just, if people want to check it out now, not right now, not as listening to the show, but after they listen to the show, they want to go, how do they check it out, sir?
So they could either dial the 888 options number and talk to those great folks at Investor Services at the OIC. They can go to optionseducation.org, or they can go to IWI.org, which is the Investment Wealth Institute, on the web.
There you go. 3 different places, listeners, for you guys to go and get your certificate on out there. I think we have a listener question about this exact topic in a little bit, because this is clearly a top of mind. And you mentioned it, Eric. This has been a long-standing thing. I remember talking this back with Alan when he was still there, and of course when you came on. It's been a long-standing thing for you guys particularly to get out there and maybe try to offer something, because this is something this audience, it resonates with this audience to have a document, a certificate, something they can hang on the wall to show their clients to say, hey, look, I've taken this coursework. I have studied in this particular area of the markets. And for whatever reason, there really hasn't been anything like that with options. So I'm glad to hear that you guys finally managed to get this ball rolling. It sounds like so far, look from the early numbers, it sounds like it's resonating pretty well, sir. So congratulations to you. Speaking of resonating, this show always resonates with the audience. So let's get you guys a little bit of extra time here on the show. Let's open up the office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com. emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, welcome to the office hours. This is, of course, the portion of the show where you guys take the reins, your questions, your comments, your insights, your pearls of wisdom. We've got many and varied here on the old program. So let's just kick things off, see how many we can get to here. Let's start, Mr. Director of Risk. I think this is the perfect one for you. This is right up your alley. This one comes from DLVC. He wants to know, does the SWAN team ever use SPY options in their overlays instead of SPX? In general, what are the crew's thoughts on the advantages of smaller contracts like SPY, or even the new, he's got the new stuff in here, or even the new CME micro futures when trading indices? It certainly seems like there's a growing audience for these products, even among larger institutions. Well, he's certainly right about the latter there. I mean, just take a look at the micro futures, for example. Those things are lighting it up across the board. There's just no shortage of demand for people to get out there and use these things. So yeah, definitely the micro. If you had any questions that people like a smaller bite-sized type contract, the recent launch of those micro futures by CME and the fact that they're blowing the doors off every day in volume certainly seems. I think they said recently that they are the most successful new product in the history of CME, which is saying something. So that's certainly an area people are excited. But Chris, this one went to you, so I'll give you pride of place on this one. First off, you guys are doing a lot of overlays over there in SWAN land for the DRS and the indices. Do you ever get down there and utilize SPY, or is it all SPX? And then B, the second part of the question, do you agree with him that, and what are your thoughts on, in general, even if you don't use them, maybe some of the use cases, or maybe in your opinion, lack thereof, for some of these smaller contracts like SPY, or even much smaller, the micro contracts?
Yeah, we certainly do use the Spider ETF and options on the Spider ETF. I guess one of the main things that it comes down to is like, well, how large is the account? If you have a larger account, you can do SPX contracts. That's easier. It's definitely easier to execute, less contracts, less commission. But on some of the smaller accounts, we actually have on one of our larger blocks, we call it our Premier block. Those are all separately managed accounts, and we trade nothing but ETFs, Spider ETFs, and Spider options on those. So again, I've said this on the show, know the nuance of your product. So yes, they're both on the S&P 500, but remember, SPX options are European style, whereas the Spiders are going to be American style. So there's that nuance that, just a little extra something that you got to look out when you are trading Spider options. And as far as the micro futures, we don't currently do any of that, but I think those are also great products because, again, it comes down to account size. How much are you willing to play with? I think they're also good learning tools because you're not going to put too much capital up, initially when you're learning how to trade. So I think they basically have opened up the door to a larger audience. So you've got an audience that, could start off with, very small amounts of capital all the way to the much larger accounts where they're going to be trading SPX options.
There you go. So they use all the above over there in Swanland to answer the first part of your question. And the second part of your question, I think we all agree, there definitely is a growing audience for look at the launch of, the E-mini and things over there at CME. And that was launched because people didn't really want to or need to use the big future to hedge. And even institutions were using it because they wanted sometimes you want to do 3 instead of a full E-mini or a full S&P future. So there's a lot of times when even a large institution maybe wants to use a little bit smaller, more bite-sized, more nuanced contract. And I think we're seeing that out there. And clearly retail likes it. So not just you, DLVC, but the rest of the trading world out there likes it as well. All right, we're getting a lot of questions aimed at specific people here. So you guys are clearly resonating. We had that one there for Chris, aka the Director of Risk. Now, Matt, here's yours. This one comes from this is a handle TLRV $4. He or she wants to know, I've heard you guys discuss collars in the past. Has Matt from ORATS ever tested the optimal construction of a collar? And can he share the secrets with the unwashed masses. So see, Maz, not just me. Everyone out there wants to use you for your data. They want to pick your brain, sir. They love your data. So TLRV$4. This is obviously a hot topic, Matt. We've discussed variations on this in the past. OCC and OIC have some great data on this. I think their collar study is, quite frankly, one of the best. I cite it all the time here on this show. They found in all their various many and permutations of it that 6 month put with the 1 month call I should say on the collar was kind of their optimal construction. I know we've touched on this in the past, Matt, but if you have any updated thoughts on it you want to share with our friend here, TLRV$4, now is the time, sir. The floor is yours.
Yes. So thanks for the question and thanks for the shout out directly at us, Mark. That's that shows that we've been on the show a lot. Definitely, the callers, and I like to look at them separately and then combine them. But we just did a bunch of short calls. So those short calls that we talked about, shorter term, 15, 30 days out of the money. Those. And again, it depends on your investment objectives. But for me, I'd like to get the income without taking too much away from my appreciation. So those shorter terms out of the money, do well on those and exit if it gets into the money and roll out. As far as the put goes, yeah, I would agree. Those longer term out of the money puts as well are the ones that test the best, and also to have some type of capture, meaning, if you've made 200 or 300% on your put, roll it out, and so you want to be active, but you also want to define what you're trying to accomplish. We're looking at sometimes that puts just on their own merit, but you might want to then combine it. And one of the things that we could do in our back tester is when we get the call or we get the put that we like, we could then put it in and combine it with a long stock position or combine it with like a portfolio that we've constructed and see how the statistics looks, how the sharps looks, how the sortinos look, how the volatility looks. And so those are the things that, it's not just pure return, but it's how the statistics look, how those return statistics look for what you're trying to accomplish, Mark.
Yes, it is an interesting one. Eric, I mentioned your collar study. You guys did it a while ago, but the data is still, I think, is some of the best out there on this topic, and you've since have updated it with a variety of different underlying. So if listeners want to learn more, maybe they want to check it out for themselves. Eric, where should they go? What should they do?
Another shameless plug, Mark, and we love you for that. It's the optionseducation.org for your listeners who do frequently go there, and we really appreciate that. And, echoing, Matt's comments, I mean, it's interesting because, going back to 2017 and the Quant Cerulli study we did in the advisor community, talked a lot about, obviously covered calls we talked about earlier on this discussion, but that collars are one of those things where advisors tend to shy a little bit away from it. But, look, as you start to build up unprecedented low cost basis and concentrated positions, and, you've got more and more IPOs this year and advisors working with executives at publicly traded companies, this is a conversation they need to have. So, let's stop, using the shirts that Tiger Woods wears without the collars, and let's go back to the collars. I'm all for it.
Back to the collars. Hey, maybe it's time for yet another variation on the collar study. What do you think, Mr. Eric? I like that one, but hey, I could talk collars for days, and certainly the audience of this show, they would be down for that, I think, given.
I'm going to echo that back to the powers that be, along with comments from Chris and Matt. Sure.
Well, since you're echoing things here, Eric, we got one here for you as well. This comes from a lot of names and numbers here, and letters and numbers. LLN93. They want to know. This kind of goes back to what we were talking about earlier, Eric, with your IWI program. He wants to know: is there a license or program that certifies someone as a licensed options professional? They could even have different variations, like a certified income trader, certified portfolio hedger, etc. Well, Eric, this is kind of something you and I have talked about for years. The notion that, there's things like the CFA, there's a Series 7, there's a Series 63. There's things that touch on various aspects of the option space, but nothing out there that really is a diehard, hey, I'm certified, I'm an official options professional type thing. People might say, well, what about the various exchanges that were out there? They had membership exams and things. And yes, they have those. Most of us here on this show have taken those at one time or another. But those, if you've taken those, you realize those are mostly about regulations and about other things, anything other than actual options implementation. So those don't really pass muster there either. And I think, Eric, maybe you can refresh my memory, but I do believe there was some impetus for this a while back. And then it seems like Bernie Madoff came up out of the blue and scared the hell out of everybody. And then the notion of suddenly any entity, whether it's OCC, whether it's an exchange, whether it's a broker, whether it's any sort of regulatory body, SRO, certifying someone as an options professional, I think that notion just went off the table. They were too terrified of certifying another Bernie Madoff, and that would be kind of the end of it. But that leads us to what we were talking about a little while ago, which was, of course, your certificate program, kind of maybe dipping your toes in those waters. So maybe, Eric, if you got any thoughts on maybe what drove your program, why we don't see other stuff like it, and maybe some other things you have to share here with the LLN 93.
Well, I appreciate LLN 93. I do appreciate the question about that. And you're right, Mark. It had come up a lot. And, look, I mean, there were trading certification courses that retail people would go. And as you know, Mark, different traders, I believe, would kind of go to these online trading academies. But I guess, without using the pun, there are options available in terms of, how, advisors kind of want to get their background knowledge. And, it's interesting, Mark, you and I talked about this so many years ago that, I always bring up the analogy that the parallel parking of your driver's ed is sort of like the options component of the Series 7. You get it done, you forget it, and it's the one that leaves you with the worst taste in your mouth. And I think that's why advisors tend to stay away from options. And that's why we kind of created a certificate, not a certification. The certificate which the advisors who wanted to put in the extra time, the wholesalers that are out there talking about option strategies to put in the extra time. But if you're working in the industry where you're buying or selling, in terms of representing other clients, Mark, you and I know that you require the registration, whether it's through FINRA or NFA, the licenses that you have to have, typically the series are the 3, the 4, the 7, the 9, the 10, the 42. I mean, I think all 4 of us had them. I don't anymore. But, when it comes down to your listener's question, there were some discussions about variations, but at the end of the day, we would say that we were very comfortable at OIC and collaborating again with IWI on this certificate program, not a certification, and maybe it will be something down the road.
Yeah, so I think what you're saying, Eric, is that you are kind of you're the tip of the iceberg there. You're kind of getting the ball rolling with
Sure.
that, with your program. They could come through. They could take that. They have a nice shiny piece of paper that they can hang on their wall at the end of it, print it out, say, "Hey, Eric Cott has certified me."
Well,
personally,
I haven't certified anybody, but
personally, Eric Cott has personally dubbed me an options professional.
Yes, and we are just very encouraged by the fact that we are getting reception. Again, I'm going to give a personal shout out to you, Mark. With all the years you've been doing this show, it has reached a crescendo in the audience and more advisors listening to it. You got great guys like Matt and Chris on here, and we just felt that it was an opportunity to show to their client base that they took that extra step. And that's where we're really encouraged by this certificate program. And we just hope a lot more people are going to go through it. It's really a very, I wouldn't say so intensive, but I think we'll have other years where we'll add to it. But this is a good first step.
A good first step indeed. Easy for me to say here. But unfortunately, that's also the final step here for this episode of The Advisor's Option. I want to thank Eric and Chris and Matt for joining me here on the program from the Southern studio here. But before we go, let me rotate back around the horn, check in with everybody, see what they have cooking that may interest you until the next time we all gather here together on The Advisor's Option. Mr. Director of Risk, let's start with you. What's cooking in the land of the SWAN blog, the 10th box events? And I've heard whispers and rumors, given the success of your recent Chicago event, that there may be another big soiree in the near future. Anything to update us on that front, sir?
Yeah, we may do another one in the fall. That hasn't; those plans haven't been laid out yet, so kind of still it's in the tinkering stage, if you will. But what we are doing is getting our 10th box seminar schedule out pretty soon here. So, and for those of you not familiar with that, that's a series of regional due diligence meetings, and it's a good opportunity for advisors and investors to meet, the portfolio managers and discuss the challenges in today's market and how the defined risk strategy can be part of their solution. And in addition, we always have great content always coming out on our website at swanglobalinvestments.com. Mark Godo does a fantastic job of always writing a blog or two every single month, so check that out.
There you go, swanglobalinvestments.com. And Chris, the OIC conference coming to your neck of the woods next year, so maybe you have to do something with the SWAN event to overlay there and maybe get that. See what I did there? Overlay, see how it all plays together? And then we could maybe have some fun cross-eventing going on. What do you say?
I definitely think that's going to happen. So we're looking forward to that, and I think we're going to have to. Everyone's going to have to bring their A game for that one here in Puerto Rico next year.
I like it. I'm looking forward to it already. And speaking of things I'm looking forward to, I'm always looking forward to the earnings move results reports, as well as a lot of other cool stuff. Matt, I just saw something recently from Mr. Otto about all your different analyzers and back testers there. People want to learn more what you guys have cooking and what exactly you guys do have cooking over there at ORATS. What do you have to tease them with, and then where should they go to learn more, sir?
Yeah, Otto is our AI salesperson. So
I had a feeling Otto was in the AI spectrum. I liked the alliteration of it, Otto from ORATS.
Yeah. We just came out with something I've been dreaming about. I know it tells a little bit about my life, Mark, that I've been dreaming about this, but the optimizer running thousands of millions of tests concurrently, all in the cloud and coming back in a table, and you could sort them all and find the best ones and then test out of a sample and stagger days there's more back testing than you could possibly sink your teeth into over at ORATS right now. So we're very excited about that. We have a scanner API, so once you find your back test, you can implement it. I'm going to be out your way for the Traders Expo. A couple of my clients have invited me to come out and see them there. So July 21st, 22nd, and 23rd in Chicago, Mark.
I like it. We'll have to enjoy a tasty beverage and perhaps a fine steak and or cigar, perhaps all three, depending, because you missed the SWAN event, so we'll have to catch up for lost time, sir.
Oh, yeah, it sounds great. My mouth is watering and my taste buds are tingling.
All right, I look forward to that. In the meantime, listeners, check them out. ORATS, ORATS.com is the place to go. Give him a follow on Twitter while you're handed. He has a catchy handle, @OptionRats. And maybe you, too, can get an email from Otto. He's a good guy. I like Otto. All right, and last but not least, Mr. Cott, we kind of just touched on, you guys have a bunch of stuff in the fire right now. You got the IWI certificate. You're traveling to every event under the sun. You have the new website over there. You, of course, have the show that is lighting up the airwaves, Coffee with Cott. If that's not enough, sir, what else you got up your sleeve you want to share with our audience here?
Well, we have to let the SWAN folks know that ORATS' G4 plane is going to pick Mark, you and I up and take us down in December for the SWAN holiday party.
I like it.
We will see our friends and family of SWAN before next year when the OIC conference happens. But I do want to thank you for having me on and to be with the guys as well. But I'll give a shameless plug for an event that we're doing. It's an in-person seminar in New York City on June 29th. My colleague will be there. It's the Executive Conference Center. OIC is doing a live workshop series, 3 option strategies for income, Saturday, June 29th from 9 a.m. to 12:30 p.m. Eastern Time, 1601 Broadway, New York City. That is free. Back-to-back Mark seminars, covered combos, iron condors, iron butterflies, all to entice you during the summer. So you can get more information, of course, at optionseducation.org.
Covered combos. You guys love that one, and I think a lot of the audience loves them too. So if collars aren't doing it for you, you want to jazz things up a little bit more, get a little bit extra return out there, maybe the covered combo is the way you want to go. And Eric and his team over there at optionseducation.org have you covered. Slide on over to the advisor tab if you want to learn more about all the data and studies and events he's talking about right there. And on behalf of Eric and Matt and the Director of Risk, and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, for sending in your questions. Keep them coming. We love to hear from you guys, and we'll see you back here next time for more of The Advisor's Option.
The
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.